Welcome back. Time for top picks from John Zechner. He's been our guest host on the street, on Market Call, I should say, throughout the course of this program, taking your questions on North American large caps. Time now for him to pick three stocks that he considers his top picks right now. We go to the auto sector for the first one, John. General Motors, ticker symbol GM, the big blue, as it was has often been known.
Yeah, I've got a theme overall, Paul, on the top picks here, and clearly a little bit more defensive right now because I'm looking at big cap U.S. where you've got some valuation support, some downside protection, so more so than aggressive growth picks. Yeah, the auto sector, I mean, they've been decimated this year. The valuations are way down. Yeah, there's some risk of during a consumer slowdown or of an economic downturn, but of slower auto sales. But I think you've already factored that in. And quite honestly, right now there's a shortage of autos. Still, these guys need to gear up production. GM specifically trading at 7 times earnings going forward. The big risk people are worried about is the migration to the EV market from the internal combustion, the ICE market. I'm sure that is a risk going forward, but they've also got a lot more on the go in terms of, they've got some initiatives in automated driving. I think they've got approved for the cruise division to test out in San Francisco now. The valuation support, is right there. They've got strong brand names too. I think if you migrate those strong brand names over to the EV market, they get over 100-year history of auto production knowledge. I think they can do this very well. So I think they can do it. They have the cash sort of to make this move across, and you're not paying for it in the market right now. So yeah, at these current levels, I'll stick with it, even though it's been, it had a miserable year so far.
So a lot riding on GM's ability to execute successfully and become a leader in electric vehicles, but you think it can do that?
Yeah, that's the same argument you'd have to make for all the auto players right now. Obviously, Tesla owns this industry right now, but the other players are coming in. Tesla's got the lead, but these guys have, like I say, got brand names and they've got experience in auto production over 100 years. So I think they will make this migration successfully, and the market is continuing to expand. It's always hard to migrate from one business to another, but I think they have the cash to do it, and you're not paying anything. At 7 times earnings forward right now, you're not paying for the risk.
Number 2, Walt Disney, also a very high-profile U.S. stock, DIS on the New York Stock Exchange. John?
Yeah, again, so many of these stocks that did well during the pandemic to a degree have given back almost all the pandemic gains. This stock's almost down 50% from the peak. I think at the 195, trading about $100 right now. When I look at it, the last 2 quarters in particular, the parks have done phenomenally well. I guess what it is, even though you got smaller capacity in the U.S. park, the margins are that much higher. I guess they raised pricing and it's still filling up. So the park side has done well, and that's with Shanghai and a lot of Europe not fully operational then. Parks is doing well. And the other thing, nobody cross-sells the media assets better than Disney. When you look at the acquisitions they've done, over time, from the recent Fox ones, obviously the Star Wars, the Lucasfilm franchises, what they've done with Marvel, they've got an exceptional library build up. And no one cross-sells their library into other assets better than Disney. I mean, they come up with a great film, make it into a TV series. You put a ride at the park, you make it a game, you make it merchandise. And now on top of all of that, now they got a streaming service, which may be losing money in the short term. But I tell you, Paul, with their library, I think the streaming will do well. I mean, at our house, I think we've got all the services right now, Netflix, Prime, Disney Plus, Paramount. If I sort of pushed a shove and we had to get rid of them all but one, I took a family vote, we'd be keeping the Disney one. So I think these guys are really positioned well. So yeah, on an earnings basis right now, it may not look as cheap as it's been because it's a money-losing proposition still on the streaming side. But on the sum of the parts basis, this stock is cheap with a lot of growth levers in place. So yeah, it's been one of the great growth stocks over the past 6 decades, and I don't think that's about to change.
Okay, now we're running a little bit short on time, but give us your quick read on Qualcomm, top pick number 3.
We talked about the chip sector earlier. These guys are really well positioned in 5G, obviously, for the rollout there, and that's what they've always been sort of bought on the basis of. Last quarter was great numbers. They're also big into IoT, the Internet of Things, so they have an expansion there. Probably trading around 12 times forward earnings, good balance sheet, strong growth. And I like to say, I'd rather play individual names in the chip sector now. Certainly Qualcomm right now would be the top of my list, so I'd take that one.
John, always great to have you on our program, and I know I speak for our viewers when I say that. John Zechner of Zechner Associates taking questions for a full hour on North American large cap stocks. That's it for us on Market Call. Thank you so much for watching. John Erkman and Bloomberg Markets up next.